Friends, thank you for being here today. We stand at a precipice in financial history, a moment where the silence on the trading screen betrays the violent undercurrents of a market undergoing a fundamental paradigm shift. As we look at the price of silver hovering around the mid-60s, it is easy to mistake this consolidation for boredom. But to the trained eye, this is the tension of a coiled spring. What if I told you that the silence you are witnessing at $65 is not a pause, but the deafening tension of a market that has defeated the banking cartel's best efforts to crash it? And why is it that a specific mathematical threshold, like 667.30, has the power to trigger a Monday panic that forces billions of dollars of institutional capital to chase the price higher, regardless of headlines or economic data? To answer these questions, we must look beyond the surface level of daily price fluctuations. We must peel back the layers of the COMEX, look inside the black box algorithms that drive modern finance, and understand the historic failure of the suppression machine that occurred this week. The battle lines were drawn, the artillery was fired, and for the first time in 40 years, the silver market did not blink. To understand the magnitude of this moment, we must first examine the battle for $65 and the failed suppression that defined this week. The events of the past few days will likely be studied by financial historians as the turning point where the paper manipulation of silver finally lost its grip on the physical reality. To understand the magnitude of this moment, we have to look at what the institutional banks attempted to do. For decades, the smash has been a reliable tool in the banker's arsenal. When silver prices rise too quickly, threatening the stability of the dollar or the solvency of short positions, the banks coordinate a massive dump of paper contracts. This usually happens at critical moments, often Friday mornings, to break investor psychology and ruin the weekly chart. This week, they deployed the nuclear option. The COMEX raised margin requirements by 10%, a move specifically designed to force leverage traders to liquidate their long positions. This is a margin nuke. It is a forced call on capital that usually triggers a cascade of selling. Simultaneously, the volume was turned up to unprecedented levels. We witnessed over 1 billion paper ounces of silver traded in a single day, more than the entire planet mines in a year. The following day saw another 600 million ounces thrown at the market. The objective was clear: smash the price back down to $60, break the technical support, and scare the retail and industrial buyers back into submission. But a funny thing happened on the way to the crash. The price didn't drop. Instead of collapsing under the weight of 1 billion paper ounces, the price of silver stood its ground. It hovered. It absorbed. It consolidated between $65.50 and $66. This is what we call holding the high ground. In military terms, the enemy fired their entire stockpile of ammunition, and when the smoke cleared, the silver market was still standing there, staring them in the face. This failure to suppress the price is the single most bullish signal imaginable. It indicates that the physical market has become an irresistible force that the immovable object of paper derivatives can no longer contain. The silence at 65.77 is not inactivity. It is the exhaustion of the sellers. They have thrown short contracts, margin hikes, and media silence at this rally, and the market simply shrugged. This resilience creates a floor, a concrete foundation built not on speculation, but on physical absorption by entities that are taking delivery. The banks tried to break the market, and in failing to do so, they have inadvertently revealed their own weakness. This resilience leads us directly into the next critical phase: the Monday panic and the triggering of the algorithmic switch. Why do we focus so heavily on a Friday close above $65? Why does the difference of a few cents matter so much? In the world of retail investing, we look at fundamentals like solar panels and deficits. But in the world of institutional flows, the money that moves markets, the only thing that matters is the weekly candle and the algorithms that interpret it. Modern finance is dominated by CTAs, commodity trading advisors, and quantitative funds. These are not human traders making decisions based on intuition. They are black box robots programmed with strict if-then logic gates. For the past month, these robots have been in a wait state regarding silver. They see the rally, but their risk parameters require confirmation before they allocate capital. The $65 level acted as a stop sign for these algorithms. As long as the price was below this resistance, the trend-following models were programmed to hold cash or remain neutral. However, the weekly close is the judge, jury, and executioner of the trend. By closing the week above 65 and specifically pushing toward the 60 seller zones, the market has effectively torn down the stop sign and replaced it with a green light. This creates the setup for the Monday panic. The panic here refers to the scramble by institutions to get into the trade, not out of it. When the weekly candle closes as a marubozu, a solid green bar with no wick on top, it signals to every computer on Wall Street that buyers were in control from the open to the close. There was no late week sell-off. There was no hesitation. Over the weekend, these massive funds rebalance their risk models. The code processes the new data, weekly close above resistance, Trend confirmed. Momentum accelerating. The output of this calculation is a buy order. On Monday morning, when the markets open, these robots do not care if the news is good or bad. They do not care about the geopolitical situation. They have a mandate to fill a position size based on the volatility and trend strength. This creates a tidal wave of buying pressure that is purely mathematical. This is why the banks are terrified of the 67.30 level. They know that once this algorithmic switch flips, they will be facing a wall of money that cannot be bullied or bluffed. The banks can intimidate a human trader. They cannot intimidate a line of Python code that has been instructed to buy the breakout. I want to pause here and ask you a question. Do you believe the banks still have the power to stop this algorithmic wave, or have they finally lost control of the machine they created? Let me know your thoughts in the comments below, because this shift in power is unlike anything we have seen before. Furthermore, we must address the weekend risk. In a typical stable market, traders hate holding positions over the weekend because of the risk of bad news. But in a currency crisis, which is what we are entering, the risk profile inverts. The risk is no longer holding the metal, the risk is holding the fiat currency. Sophisticated money is terrified of the Sunday gap. This occurs when the Asian markets open on Sunday night, Western time, and react to the weakness of the American close. If silver closes strong on Friday, Asia often gaps the price up by $1 or $2 before New York even wakes up on Monday. If you're holding cash, you effectively lose purchasing power while you sleep. You might go to bed with silver at $65 and wake up with it at $67. You cannot buy the intervening prices. You have missed the move. This fear of missing the gap drives the buying pressure into the Friday close. It creates a feedback loop. Traders buy to avoid being naked cash over the weekend, which pushes the price higher, which triggers more algorithms, which creates a higher open on Monday. We are watching the transition from a market driven by human speculation to a market driven by machine execution. While the algorithms provide the fuel for the immediate move, we need to consult our technical GPS to see the long-term roadmap, which is currently forming a massive cup and handle pattern. We must zoom out from the minute-by-minute drama and look at the monthly chart to understand the magnitude of what is happening. We are witnessing the resolution of a massive cup and handle formation. This pattern began with the 1980 peak of $50, followed by a grueling 30-year bear market that formed the rounded bottom of the cup. The price returned to $50 in 2011, completing the right side of the cup. For the last 13 years, from 2011 to 2024, we have been forming the handle, a period of consolidation and downward drift designed to shake out the weak hands and build a base for the next leg up. Technical analysis dictates that the bigger the base, the higher in space. A pattern that takes nearly half a century to form does not resolve itself with a measly $5 move. It resolves with a measured move. To calculate this, technicians take the depth of the cup, the distance from the 2001 lows of around 4 to the 50 rim. That is a $46 range. When the price breaks out of the handle, you add that range to the breakout point. $50 breakout plus $46 depth, Steuer's $96. This is not a number pulled from thin air. It is simple geometry based on market psychology and historical price behavior. The current price of $65 or $66 is merely a waypoint on this journey. We are barely 1/3 of the way through the projected move. This context is vital because it reframes the current volatility. A drop from $66 to $64 is noise. A move to $70 is just progress. The destination is near triple digits. Zooming into the intermediate term, we see the importance of Fibonacci extensions. Nature and markets move in ratios, specifically the golden ratio of 1.618. Projecting from the recent lows to the breakout levels, the algorithms identify $72 as the next major magnetic zone. The area between our current price of 65 and the target of 72 is technically significant because it is a low friction zone. Historically, silver has spent very little time at these price levels. There is very little price memory, meaning there are few trapped buyers from the past waiting to sell and break even. When an asset enters a zone of low price memory, it can move with startling velocity. The air is thinner up here. The resistance is lighter. This suggests that the move from 65 to 72 taus could happen much faster than the grind from 20 to 30. We also need to address the overbought fallacy. Novice traders look at the relative strength index, RSI, on a daily chart, see it above 70, and scream, sell. They believe the market must crash because it is overheated. This is a fundamental misunderstanding of how momentum markets work. In a true supercycle breakout, an asset can stay overbought for months. Look at Bitcoin in 2017 or Nvidia in 2024. They hit overbought status and then proceeded to double in price. Why? Because the buying pressure is so intense that it pins the indicator to the top. The RSI stops functioning as a warning signal and starts functioning as a confirmation of velocity. Selling a breakout because the daily RSI is high is like jumping off a moving train because the speedometer says it's going fast. The weekly RSI, a far more reliable indicator for long-term trends, is currently in the 70s. In previous peaks like 1980 and 2011, it reached 90 or 95. This divergence tells us that we have massive room to run before the market becomes truly euphoric or dangerous. Underneath these technical patterns lies the plumbing of the market. And right now, that plumbing is showing signs of a gamma squeeze and the ominous ghost of backwardation. The plumbing is leaking. This week, we saw the mechanics of the options market turn against the banks in a phenomenon known as a gamma squeeze. Market makers, the entities that facilitate trades, usually try to pin the price at a max pain level on Fridays, ensuring the maximum number of options contracts expire worthless. This week, they lost control. Thousands of call options with strike prices at $65 expired in the money. This is a nightmare scenario for the banks. When a call option expires in the money, the writer of that option, the bank, is contractually obligated to deliver the metal to the holder. If the bank does not have the physical metal, which, given the inventory reports, they likely do not, they must go into the open market and buy futures contracts to hedge their exposure. This creates a forced buying loop. The higher the price goes, the more options fall in the money. The more options in the money, the more the banks have to buy to cover. The more they buy, the higher the price goes. This is the gamma squeeze. Heading into the weekend with the price at 65.77 or higher means the banks are trapped. They cannot hedge while the market is closed. They have to sit and steward that risk until Monday morning. When the bell rings, their first order of business is damage control, which means buying. But there is a signal even more alarming than the options market: backwardation. During the live trading sessions this week, we witnessed the silver market flicker into backwardation. In a healthy market, the futures price, the price for delivery next month, is higher than the spot price, the price for delivery now. This contango exists because of the costs of storage, insurance, and interest. You pay a premium to buy it later. Backwardation is the opposite. It occurs when the spot price becomes higher than the futures price. It means that traders are willing to pay more to get the metal right now than to wait a month. This is a red flashing light that signals acute physical shortage in the wholesale market. It means industrial users and sovereign buyers do not trust that the metal will be there in the future. They want it in hand, immediately, and they will pay a premium for that security. We saw silver futures hitting $66.23 while spot was lower and then flipping, showing the desperation in the plumbing. When backwardation becomes persistent, it signals that the paper pricing mechanism is breaking. It is the ghost in the machine telling us that the vaults are emptier than the official reports admit. We also have rumors circulating, unverified but persistent, of a major financial institution receiving a massive margin call on their silver positions. There is chatter that one of the big players, perhaps even a bank like JP Morgan, has flipped their book. The rumor is that they have sold off their short positions and are now net long physical silver, perhaps holding hundreds of millions of ounces. If the biggest bear in the woods has decided to become a bull, the suppression game is effectively over. They are no longer incentivized to cap the price, they are incentivized to let it run. While the robots and bankers fight their mathematical war, we must also recognize the fundamental shift in psychology that has transformed the market participants from sheep into wolves. For years, the banks relied on a predictable script. Let the price rise to a psychological level, like $50 or $65, and the retail sheep will rush to sell their stacks to lock in profits. The banks count on this supply to flood the market and cool the price. This week, the banks waited for the sheep to sell, but the sheep didn't show up. The wolves did. At $65, we did not see a mass exodus of silver stackers lining up at coin shops to sell. Instead, we saw the opposite. We saw holding. We saw buying. This is a critical change in psychology that characterizes a super cycle. Investors have looked at the broader economic landscape, the $35 trillion national debt, the persistent inflation, the geopolitical instability, and they have realized that $65 silver is not expensive. They realize that 65 silver is simply the market beginning to price in the devaluation of the currency. The retail investor has realized that selling silver for fiat currency is a losing trade. Why trade an asset that is repricing higher for a currency that is inflating away? This strong hand psychology removes a massive source of supply that the banks were counting on. Simultaneously, the mainstream media narrative is pivoting. For years, financial networks mocked silver or ignored it. Now, we see headlines on Bloomberg and CNBC asking, "Is silver the new lithium?" or noting that silver outperforms gold. This media validation is the dinner bell for the general public. We are moving from the smart money phase to the public participation phase. The average person does not read mining reports or study backwardation. They buy what the TV tells them is hot. When the media validates the shortage, it gives permission for pension funds, financial advisors, and average citizens to enter the market. This wall of money is far larger than the futures market. When the herd arrives, valuations do not just rise. They go irrational. They go vertical. Underpinning all of this is the undeniable industrial demand. We must mention the Samsung factor. The development of solid-state batteries, which require significantly more silver than traditional technology, is a game changer. This is inelastic demand. Samsung cannot build the battery without the silver. They do not care if silver is $25 or $75. They need the metal to keep the factory running. This industrial demand sets a floor price that speculators cannot smash through. And the industrial user is the ultimate buy-the-dip whale, absorbing any inventory that speculators try to dump. If you are finding value in this analysis and want to stay ahead of these market moves, please do me a favor. Smash that like button and subscribe to the channel. It helps us break through the noise and get this critical information to more people who need to wake up. However, understanding the mechanics of the market is only half the battle. The other half is mastering the discipline of the art of sitting tight in the face of a macroeconomic storm. We have spoken at length about the weekend risk, but we must place this concept into the broader geopolitical theater. We are not merely trading a metal, we are navigating a currency crisis. The risk of holding silver over the weekend is terrifying to a novice, but to the veteran, the risk is holding the dollar. Consider the landscape. Banking system instability, rumors of export bans from major producers like China or Mexico, and the escalating BRICS narrative of de-dollarization. These are not events that schedule themselves conveniently during New York trading hours. They happen while you sleep. They happen on Saturdays. If a major geopolitical event breaks over the weekend, a mine strike in Peru, a new tariff, a banking failure, the market does not politely wait for Monday morning to reprice. It gaps. This is the nightmare of the cash holder. You might go to bed with silver at $65, and on Sunday night, Asian markets could open trading at $68 or $70. If you are sitting in cash, you have been locked out. You cannot buy the news because the shop is closed. This is why the smart money refuses to be naked cash over the weekend. They treat silver not as a speculative vehicle, but as an insurance policy against the chaos of the fiat system. This brings us to the most difficult skill in finance, one that is far harder than reading a chart or analyzing a balance sheet: the art of doing nothing. There is a legendary story about Jesse Livermore, arguably the greatest trader of the 20th century. When asked how he made his fortune during the great commodities booms, he replied, "It was never my thinking that made the big money for me. It was always my sitting." Sitting sounds easy, but in a supercycle, it is excruciating. Right now, many of you are sitting on substantial profits. The urge to tinker is overwhelming. The human brain craves action. You will see a scary headline this weekend about interest rates or a double top pattern, and your instinct will be to sell half your position, to hedge, to try and outsmart the market. You will want to sell at $69.99, hoping to buy back at $68. This is the enemy. This is how they steal your position. In a bull market of this magnitude, the noise machine of the financial media ramps up specifically to shake you out. They need volume. They need you to trade. But if you prune a flowering tree, you kill the fruit. The Livermore rule dictates that as long as the trend is intact, and a weekly close above 65 DOST confirms the trend is stronger than ever, you do absolutely nothing. You suppress the urge to be smart. Being smart gets you killed. Being patient gets you rich. The banks are counting on your anxiety. They know that if they can create enough volatility, enough wicks and dips, you will panic and hand over your physical silver or your mining shares just before the vertical move. Do not give them the satisfaction. Turn off the news. Ignore the weekend fear-mongering. The price will be there on Monday. If we gap up on Sunday night, do not chase the spike with leverage. Just smile, knowing that the market is teleporting higher to find sellers because there is simply no inventory left at the old prices. We have moved from the realm of speculation to the realm of scarcity. And in a scarcity market, the most profitable action is often inaction. So where do we stand as we look toward the next trading week? The outlook is now defined by two words: victory and velocity. The verdict is clear. The bulls have won the war for $65. The suppression failed. The floor is established. We are looking at an immediate target of 67.30 to 70. The 67.30 level is the trigger for the next wave of algorithmic aggression. Once we clear that, the psychological magnet of $70 will pull the price in. As we discussed, the resistance between here and $72 is weak due to the lack of historical price memory. Do not be surprised to see days where silver moves 2 or 3 in a single session. By the end of the year, a target of $75 is now a conservative estimate based on the current velocity and the breakdown of the short sellers. But looking further out, into the first quarter of 2026, the technicals of the cup and handle point us inevitably toward triple digits. The $100 level is no longer fantasy. It is a mathematical projection of a 45-year cycle resolving itself. We are also witnessing a restructuring of the global asset hierarchy. Silver has recently moved up the ranks, surpassing major tech giants to become the fourth or sixth largest asset by market cap, sitting around $3.5 trillion, depending on the specific metric of available supply. This is not just a price increase, it is a return to status. Silver is reclaiming its role not just as an industrial commodity, but as a premier monetary asset alongside gold. In conclusion, friends, the Monday panic is not a panic of fear, but a panic of acquisition. The banks are trapped in a short squeeze of their own making. The algorithms have switched from neutral to buy. The physical market is in backwardation, and the holders of silver, you, have refused to sell. The era of hoping for fair value is over. We have entered the era of certainty. The deficit is real, the shortage is undeniable, and the price is finally violently catching up to the truth. The closing bell has rung on the era of suppression, and the opening bell on Monday signals the start of the era of discovery. Stand fast. The train has left the station, and it has no brakes.